Canada just posted its first merchandise trade surplus in 6 months. Total exports hit $72.8 billion in March, the second highest level on record. The forecast was a deficit of $2.88 billion. Instead, the country swung to a surplus of $1.78 billion. That swing of more than $4.6 billion in a single month is not a rounding error. It is the largest positive surprise in Canadian trade data in years. Energy drove it. Oil prices jumped nearly 20% as the Iran conflict escalated, lifting Canada's energy exports 15.6% year-over-year to their highest level since late 2022. Gold exports surged at the same time as investors rotated into safety assets. The TSX closed lower Thursday on profit-taking ahead of Friday's jobs data, but the broader week carried a tone of cautious confidence. Sun Life Financial hit a new 52-week high after an analyst upgrade. Canadian Natural Resources raised its quarterly dividend, and Shopify shares climbed 6% on the day. The trade surplus should have been unambiguous good news. For a few hours, it was. Then another headline landed. Honda is indefinitely suspending plans to build a $15 billion electric vehicle manufacturing plant in Ontario. Not pausing for a quarter, indefinitely. Prime Minister Mark Carney told reporters there are challenges with the U.S. tariffs in the auto sector. Finance Minister François-Philippe Champagne said the word is hold, and that it is not unique to Canada. He pointed to Europe and the United States, where EV demand has slowed across the board. The same day, a separate report quantified what those tariffs have already cost. U.S. automakers paid $12.5 billion in tariffs on Canadian and Mexican cars and parts in 2025 alone, more than $1,600 per vehicle. Canada posted a record trade result and lost a $15 billion factory commitment on the same morning.
The mechanism behind this divergence is worth naming plainly. Canada's trade surplus is almost entirely a price effect, not a volume story. Oil prices moved because of geopolitical risk in the Middle East, not because Canada pumped more barrels. Canadian Natural Resources averaged 1.64 million barrels of oil equivalent per day in Q1, a strong result, but not the reason exports hit record levels. The price of crude was the reason. Gold moved on safe haven demand. Both of those tailwinds are external, event-driven, and reversible. A U.S.-Iran diplomatic settlement, which traders were already pricing in Thursday, sending oil lower, could unwind both simultaneously. The Honda withdrawal is a different category of signal entirely. A factory is not a price effect. It is a capital allocation decision by a company betting on where the next decade of industrial activity will sit. Honda's original $15 billion announcement in May 2025 was structured around an EV supply chain, battery production, vehicle assembly, and parts procurement, all anchored in Ontario. When that anchor lifts, the supply chain logic collapses around it. Honda's withdrawal doesn't erase the Canadian trade surplus, but it removes the industrial infrastructure that would allow Canada to compete on manufactured goods rather than raw material prices. This is the condition where the trade surplus becomes a liability rather than an asset. If commodity prices reverse, Canada has fewer manufactured goods exports to absorb the shock. The $12.5 billion tariff burden on North American auto trade isn't lifting. The CUSMA review is approaching. A Mexican trade delegation was in Toronto this week seeking to strengthen ties before the review date, and the outcome of that review will determine whether automotive investment in Canada is viable under U.S. tariff policy or not. Canadian Natural's president said it directly. The industry needs a West Coast export pipeline capable of moving 1 million barrels per day from Alberta to British Columbia before oil sands growth can continue at scale. That pipeline does not exist. Existing infrastructure is already at capacity. So even the energy side of the surplus has a ceiling, and that ceiling is physical, not financial.
The case for dismissing the Honda news is straightforward. EV demand has slowed globally. Ford and GM have pulled back on EV timelines. The pause is industry-wide, and a temporary hold on one factory does not define a country's industrial trajectory. If U.S. tariff policy eases through a new CUSMA framework, or if EV demand reaccelerates past a threshold that makes the Ontario factory economically viable again, Honda's calculus changes. BCE's announcement this week, raising its AI data center revenue target to $2 billion by 2028 and disclosing an 800-megawatt power pipeline in Saskatchewan, is a reminder that Canadian capital is being deployed in new industrial directions, even as legacy manufacturing retreats. The case for concern is also straightforward. The trade surplus that looks like a buffer is built on inputs Canada does not control: Iranian nuclear negotiations, Federal Reserve rate decisions that move gold, and pipeline capacity that will take years to permit. When the Ontario budget relied on Honda's $15 billion arriving, those revenues were factored into planning assumptions. They are now gone on an indefinite timeline. Bell Canada is facing a CRTC warning that its new $40 device handling fee may be prohibited. A small headline, but symptomatic of regulatory friction that adds cost uncertainty to every corporate investment decision made in Canada right now. The verification point to watch is the CUSMA review timeline. If negotiators signal a path that exempts Canadian auto parts from escalating tariffs before the end of Q2, the conditions for reinvestment improve materially. Shop's continued climb toward analyst targets in the 150 to 200 range suggests the market still sees Canadian tech as a credible growth story. CNQ's ability to sustain its dividend and grow production toward that pipeline unlocked ceiling is the commodity side benchmark. The trade surplus says Canada is selling what the world needs right now. The Honda withdrawal says the world may not need what Canada is trying to build. Both statements can be true at once, and that tension, not the surplus number, is the signal worth watching on Friday when the jobs data arrives. Every day after the close, we publish a market wrap and key issue analysis. Subscribe to the channel.